The full state pension pays £11,973 a year. Add the average private pension, an extra £8,000, and that takes you to just under 20k a year. The government says a comfortable retirement costs £43,900. That's a gap of nearly £24,000 every single year, and most people have no plan for it. And the reason most people have no plan isn't that they're not trying, it's because everything they've been told to do, pay into a pension, save what you can, trust the system, it isn't actually designed to close that gap. It's designed just to get you by. The people who do retire on their own terms aren't the ones who've saved harder, they're the ones who invested smarter. I've been doing this for over 12 years, averaging over 30% annual returns, and in this video, I'm going to show you exactly how. A full state pension pays £11,973 a year. Now let's couple that up with a private pension. Hopefully somebody's taken a sip and, grown it, and that is actually saying that over a 35-year period, doing the auto contributions, then you could expect a private pension of up to £150,000, which, over 35 years of contributions, that actually only equals an extra £8,000 a year of payouts. So let me get this straight. You've got your £11,900 from the state, you've got your extra £8,000 from private. Well, that's not even 20. So how on earth is anybody supposed to live on 20 grand a year? Now, I don't know about you guys, but I am in the UK. You can't do much with 20 grand a year. And that's at today's prices. I don't know if you've been in the shops recently, but things are not getting cheaper. And I actually think this is a really good point that people don't think about, because people set goals and think about their pensions and things in today's money, but things aren't going to be in today's money when you retire. Like, you hear the stories from grandparents of how, a house used to cost 500 quid or whatever, but that's going to be you. Like, you're going to be saying about how things used to cost now, but when you're there. So saying, oh, all right, well, got £20,000 coming in a year from a pension, like that will buy XYZ. It won't buy XYZ in those years. It will buy so much less. So people really have to look at this now so that you've got a time to make a change. Like, let's put it in real terms. How much do you pay at the moment for rent or a mortgage? Probably quite a chunk, and that'll take a big chunk out of your 20 grand a year, right? I mean, I was just looking at the residential care costs, which, let's be real, some people are going to need that when they're in their pension ages. The average cost of residential care is £1,298 a week. That's not a month, that's a week. So imagine what that will do to your pension pot if you need care for even 2 or 3 years. Well, based on that average private pension, that's the entire thing gone. Then what? What are you expected to do? And I think the real crime of this is a lot of people trust the so-called professionals and the pension funds to secure their future by you thinking you can just give your money to them and they'll take care of the rest. But I've been seeing funds return things like 3% in the last year. 3%, nothing's only gone up 3%. You go into your shops, everything that used to be £1 is now £1.50. Things that used to be a fiver are now £7. Like, nothing's only gone up 3%. So if things are getting more expensive, i.e. inflation, faster than your pension's growing, you're going to pay the price. And look, the next step beyond that, which is probably a lot more logical, is what people look at with like the index funds and those kind of investments. And they're definitely better. So controlling your money and putting them in the index funds is awesome, but they're averaging 7 to 10% a year. Again, awesome, better than a savings account, I'm sure you'll agree, but are things really only going up 7% a year? I honestly believe true inflation is at least double figures. So you've got to be making at least 10% a year, in my view, to just stay evens. Well, if your investments are only making 10% a year at best, you're probably not going to make much. You're not going to make much freedom. This is where I think having a structured approach to your investments and actually investing in individual stocks is going to make a massive difference to your future. And this is why I choose to use the VAX strategy for my personal retirement fund. So here's how this actually works. This is the process I've used over the many years now, where I invest in less than 5 minutes a day by having a very step-by-step approach. Now, VAX, V-A-X, it stands for Value Averaging Extra. Now, I know extra begins with an E, but the A-E didn't sound as good, so it's extra with an X. But Value Averaging Extra. So these are the 3 pillars. And having all 3 pillars in my investments means that there is no room for emotions to get involved, because I've got this step-by-step approach to keep me on track, making sure I'm making the best investments possible. And if you're also trying to build something for your future, whether it's a pension or a brighter future for your family, you've got to have that same structure too, because without that, you're going to feel like you're gambling, and nobody builds a great future by gambling. Okay, so let's take a look at one stock that's pretty interesting at the moment, and this is Nvidia. So looking at this, you've got all of the background stats for Nvidia, which is the fundamental analysis. So I'm looking here and I can see like the size of the company, so market cap. For me, that's actually really important, like to know that I'm investing in the biggest companies on the planet. Well, this is 4,148 billion at the moment, which is 4.1 trillion. So they're doing okay. But also on this page, I can see, look at their profit margins, 55.6%. So for a company that size, that is an incredible margin to have. And equally, looking at things like the institutional ownership, which is a really interesting stat, which shows how much of this company is owned by the big guys, the hedge funds, the banks, those ones. Because if you think about it, who has the most access to information in the world of investing? Is it us normal people? Of course not, right? The big guys have way better access than we do. So if you can see that an investment you're planning to make is also backed up by them, like in this one, you can see 68%, that's 2/3 of this company are owned by the big guys. It's probably quite a reassuring thing to see. So fundamentally, this stock looks really, really good. And you can see all the stats there to make make that decision. Now, this is the value side of things, making sure we're investing in the fundamentally strong stocks. Then we move into the second pillar here, which is around the averaging. So rather than just saying, oh, right, this company is a good company, I'm going to throw all my money into it in one go. Well, what we're better to do is split our money into smaller chunks and what they call average into it. So I base my numbers on a spreadsheet that I created with some in-depth calculations, but this is essentially the process. So I'm saying, okay, well, when the stock drops to these blue lines, these are my times to buy. So when it hits that, I'm going to invest some of my money. If it drops down, hits the next one, I'm going to invest some more of my money. If it drops to the next one, some more of my money, so on and so forth. So that if this stock is dropping in price, I can buy it at the cheaper price. I'm getting a better deal. Now, I know some people look at that and think, oh, it's a bit risky buying a stock that's dropping. Or if it's a bad stock, yeah, it's probably dropping for a reason. If a great company, a fundamentally strong company is dropping in price, it's on sale, like any other asset. And if you were saving up for a house to buy and then you looked the next day and you saw it's actually got 50 grand off the sale price today, well, you wouldn't see that as a risky thing, would you? You'd be like, oh, great, they're trying to get rid of it. That's a great deal. Let me go and get that. Same thing with stocks. You've got to remember you're buying assets here, not risky investments. So I want to buy the stock as it drops further. But of course, it doesn't always drop, does it? It could drop a little bit and then shoot up. Well, in that case, if I've only bought once or twice and then it shoots up, great, I've made a quicker profit than I actually planned for. But if it keeps dropping, like sometimes happens, well, I've got a plan for that too. It puts me in a really interesting position where I honestly don't mind if my stocks go up or down because I've got a plan for it. Probably already you can see how that's way more powerful than just throwing your money in and hoping it goes up. This would be the averaging portion of the process. And then we get into the last stage here, which would be the extra, which is around the exiting phase of it. So as I just alluded to, if the stock buys like once or twice and then starts going up, I'm in a quicker profit than I planned. But rather than getting into a place where I'm like, oh, I think this is enough profit, or I feel like this is enough, as people say. That's silly. Never get into that phase. If you ever say the words feel or think when you're investing, check yourself because you're probably going to make a mistake. Instead, I know that instead of just clicking sell, I'm going to wait until I get to a certain percentage profit and then I'll put in a safety net. What is it officially called? A stop loss. So a stop loss is an order you can set on your broker to say, look, if the price drops to this, sell the shares for me automatically. So when I'm in a certain amount of profit, rather than just saying sell now, I'm going to put a safety net just below that. And then if the stock does drop, great, it'll hit my safety net and sell. But of course, alternatively, the stock could keep rising. If it keeps rising, what do you think I'm going to do to the safety net? And keep bumping that up, right? To secure more and more profit. Nothing goes up forever. So eventually it will drop, but it will drop and sell automatically. So if I'm at work, I'm busy, I'm on holiday, whatever, doesn't matter, it'll just do it for me. So that just ensures that I get the profit that I'm aiming for. Okay, so let's take a second example here because you want to be in different industries. You want to diversify by being across different industries. For me, I like to be in 5 at once. So obviously Nvidia, biggest company in the world, tech, easy to identify. Then you've got other industries like gold, for example. Now, obviously buying physical gold is seen as a really safe hedge against inflation, meaning when the world is maybe in a bit more times of crisis and things are a bit crazy and prices are rising, gold is typically seen as a good place to store your money to stay up in line with that. Of course, though, buying physical gold has its limitations. Like you've got to physically go and buy it, store it, it's not as liquid, you can't sell it as easily. So I actually like an alternative that is to buy gold mining companies. It means you can actually buy stocks and benefit from the price of gold. It's kind of like the best of both worlds. So let's look at this one here, Barrick Mining Corp. So again, you can have a look through Barrick, they're like a $66 billion company. They're pretty big, good profit margins. Obviously, they're backed by the asset of gold as well, which really helps. So adds a layer of security there for you. So again, from this screen, you can see all the different stats they've got and they're doing very well. So I might look at this and say, okay, well, if I want to be exposed to gold, because I see that as a safer place to put my money at the moment, cool. So I would do that. I'd choose, let's say I opt for Barrick. I go and look for them on here and I can see, okay, well, rather than throwing all my money in one go, of course, I'm going to average into it, no matter whether it's gold, tech, medical science, or whatever it is, I'm going to put the money in averaging it, buying it in, okay? Always buying stages. So I've done it on here, just these blue lines here as examples. So I buy there potentially at the current price, and if it falls, I can buy some more. Just means I'm buying this asset at a lower cost each time. And then, of course, following the same strategy every single time, I'm now looking, once I've bought that, if it goes up, if it's going up to a certain percentage profit, well, that's when I can put my stop loss in. But by the way, that process of, buying in from the first time and then getting to the point where it's at the stop loss, that can take a range of times. It could take a week to do that. I could buy it and then it instantly shoots up. It could take months. My average investment at the moment, it takes 2 to 3 months. So have a think about that. And I have 5 stocks at a time. So if I know that it's going to take on average 2 to 3 months, there's not a huge amount I need to be doing every single day. Like I've just said, I've found the stock, decided where I'm going to buy, I can set those orders and I know where I'm going to sell. So I'm not doing that again tomorrow and the next day. No, once I've set it, I can pretty much set and forget, which is why this makes it a really convenient approach for busy people who want to build something for their future to implement. So here's what those numbers mean for your retirement. Because think about it, when I say to people, over 30%, whether it's 40%, 50, even 60, people think, that's impossible. How could you ever make 30% a year from the stock market? I heard you can only make 10%. Well, here's actually the real secret, because we're not trying to make that in one go. Typically, when people say 10% a year, it means they bought at the start of the year, held it the entire year, and by the end, it's gone up 10%. Well, that's a very different strategy to buying and selling. Because in this strategy, we're investing in 5 stocks at a time, and I'm actually only aiming to make 10 to 15% profit on each of those. Okay, sometimes I'll make a little bit less, sometimes I'll make a bit more, but my goal is 10 to 15%, and I actually won't get into an investment if I don't think that that's possible. So I aim to 10 to 15% on each of those stocks. Each take 2 to 3 months on average. So instead of trying to make that 30, 40, whatever percent throughout the year in one go, I'm actually just stacking the small wins on top of each other throughout that 12 months. And that's a hell of a lot more achievable. So as you can see, if I just said to you, you've got to make 10% on this stock and then, 10 on that one and 10 on, if you can do that several times throughout the year, that compounds very quickly to achieve those bigger numbers. And that's actually how we do it. So how does this really play out? I'll use the calculator for this just to demonstrate, because, all right, let's say you start with, even though we're talking about retirement here, I'm hoping your retirements and pension funds are a little bit more than this, but let's just say you only had 10 grand to invest, 10,000. Or if you were making, let's say 30% returns on that, just starting with 10 grand, this is not adding a penny to it, just letting it compound itself and grow. So what's this? You've got 1 year, 2 years, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so 10 grand put in, never adding to it again, not putting another penny in. Over a 10-year period, achieving that goes to £137,000. Well, if you think how long it took you to save the 10 grand in the first place, it'd probably take you a hell of a lot of time to save up the 137, right? You can see how investing the money and letting it compound goes way, way better than just putting it in a pension fund that takes you, adds your 3% a year to it. That's why I think investing is essential, and why you taking control of your money is the only thing that's going to save you in retirement. Now, one thing you might have noticed while I was doing that calculator exercise, the first few times you press equals, the jumps are fairly small, but by the time you're clicking it like the 8th, the 9th, the 10th time, the jumps are much bigger. And that's what compounding is. It's like the snowball effect. So here's a real key to wealth, to combat. People want to know the secret to wealth. There's no secret, it's just compounding. But compounding needs time. So if you're starting now and letting that compound start from today, great. That's way better than starting in 5 years time, 10 years time, because you'll still be starting from the same place as you are now. Everyone knows that, the best time to plant a tree was 20 years ago. Second best time is to start today. It's the same thing with investing, because by delaying the start, you would be delaying the end. So just get going. If you want to see the full framework, click the link in the description to see the free online masterclass. Let me keep going. So how do you build towards a retirement that you really want? I think a really good idea is to figure out what monthly income would you need to live the life that you want. So not what big pot do you want to achieve? What's that big, sparkling number? No, what monthly income would you need to live the life that you want? Because once you know what that is, you can reverse engineer it. So for example, I'm going to use easy numbers here. Let's say that you knew you only needed 3 grand a month to live a good life. It's probably a bit low, but let's just say 3 grand a month. Well, over the year, that's £36,000. So if you were making 30% a year profit, you'd need just over 100 grand in your account to make that, right? That would be really easy. Now you can use that to extrapolate to whatever you do want. So let's say you wanted 6 grand a month. Great. Well then probably, if you're only making 30% a year, you probably want to have 200 grand in your account, in your pot. And we've just seen, you can grow to that over time by just letting the compound effect happen. So my first task for you would be to think, what number would I need to come in each month to cover all my expenses and let me live a comfortable life? And when you break it down like that, it makes it very achievable. And you'll notice that the people who live this great life where they retire early and live the life they want, it's not the ones who earn the most in their lifetime. It's the ones who started investing sensibly early as possible and let that compound effect grow. Let's say, for example, you're 45 and you're like, okay, I've got 20 years until retirement, whatever that means. 20 years is a hell of a long time that you can build up a significant pot there, way over your 100 or 200 grand, and have that pot sitting there. And the other thing to remember is when you built up that pot, it's not like you've got there and then it never grows again. You're going to keep investing at that point. You're not going to get to retirement and stop investing. So that's actually only going to get bigger and bigger and bigger. So yes, it might give you your 6 grand a month at the start, but when that grows and it gives you 7, 8, 9, 10, so that you're earning more and more as your life goes on. Let's say you're closer to retirement. Let's say you're 60 and you're like, okay, well, I've got probably 5 years left before I want to retire. Well, then you definitely need to get started, right? And it's never too late. Don't get me wrong. I think the oldest member in the trade tribe in my community at the moment is 89. But really is never too late. But obviously, if you've got less time before you want to retire, you really need to get into it. Because let me get real for a second. There's going to come a point when it comes to retirement where you want to stop relying on your salary, your active income, and you want to purely rely on your investments, whether that be pension, whether that be whatever. So let's get that pot to the best it can be as soon as possible. You don't want to wait until you want to retire to realize, I haven't done enough yet to make this possible. And you definitely don't want to have to retire and pull back on your lifestyle, because you've worked hard your entire life. You might actually enjoy those years. That's kind of the point of it. If you found this useful, I made something that goes much further. It's a fully free masterclass where I walk you through the entire VAX framework, every step of the research process, how to size your positions, and how to build a portfolio that actually funds the retirement that you want. It's on screen now and linked in the description. Subscribe for more content like this, and I'll see you on the next one.